Hello everyone, this is Chris. I want to welcome you to our first Connect series of 2017. I want to wish each of you a happy new year, and also just extend a huge thanks to all of you that are members. I'm just really grateful, when another year rolls around and I think about many of you on the line are new members and giving us a try, and I'm very humbled and honored to do that. But I'm also very humbled and honored that many of you that are on this call have been members for years and years. I appreciate so much that you continue to allow us to be a part of your life. I know you have choices for investment decisions, and I'm just really humbled and honored that you're giving us a chance, and I'm really excited about things that are going on. We've got I never thought it was a legitimate excuse, but we've got the election behind us, and I enjoy movement. I'm not a bull or a bear. One of the things that we continue to start off these Connect series with is I believe that being bullish or bearish is nothing more than a psychological state of mind, not a strategy. It's not the power of the pattern and how you make decisions. Being bullish or bearish, we want to use the tools of the power of the pattern to help you make those. And so I just always want to start off the meeting with this type of a reminder that we're not bulls or bears. I'm not smart enough, everybody, to know how all of this is going to turn out, but I do know that it's going to be movement. Money's going to flow somewhere, which spells solutions and opportunities. So one of the things that I want just to remind of, in honor of my hero and mentor, Sir John Templeton, that bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. And Sir John, as many of you know, he said outside of the Bible, the book that I learned the most from was the Extraordinary Popular Delusions and the Madness of Crowds. And one of the things that, even though most people know Sir John as a great fundamentalist, which obviously, he was to me one of the best at judging worldwide investor sentiment. And so that's one of the things that, I know I'll never be as good as Sir John by any stretch, but one of the things in reminders of him and his good principles, we're always trying to find is pessimism that coincides with support in assets and oversold momentum, and we're also looking for euphoria on the other side. So I always share these pictures of this unique-looking gentleman, because I want to just remind you that when you see this type of pessimism in yourself, coworkers, family, friends, people on TV, it's probably relating to an opportunity. And when you see cockiness getting up there too high, when it gets too high, we have to be concerned and start looking at harvesting. One of the things I wanted to start out the meeting with today is just, what do we own right now? Just, we're into a new year. I know all of you have been busy with family and friends and work and travel, and so here's the positions, that we own at this time. Picked up a couple today towards the bottom of this sheet, which we'll cover, later, that had to do with January seasonal plays. But just a reminder, we've got a small position left in banking or finance, commodities that aren't really going much of anywhere, a bond position in AGG, the junior miners, sugar, Weatherford Financial, an energy play, Stryker today, and Boston Scientific. And then here's the positions and the gain or losses over since the last week. So I want to kind of try to start doing this just so you can see where we are, and then we'll get into the meeting. Today we're going to cover some interesting things on interest rates, or what I think is interesting. We're going to look at stock indices. We're going to cover a little material on currencies. We're going to dig into some metals a little bit, and also what things have, we're at the beginning of the year. We're going to look at what has really done the best and the worst over the last 4 years, and see if we can find some opportunities there at both ends of the spectrum. So looking at interest rates, a lot of people are saying, oh, the 30 or 40-year bond bull market is over. I'm not smart enough to know that, but on the left, I want you to see is the yield on the 10-year note, and on the right is the yield on the 30-year bond. To me, I can't say that, yes, everyone, we shorted bonds last July and participated in the majority of this rally from a short position, and then just set aside and let rates go back up. But to me, when you look at this is a 13-year channel and the 30, roughly the same time frame on the 10 on the left, that they both hit falling resistance, because yields are in a falling trend, lower highs and lower lows for 30 years, hit resistance here, and they backed off some. You know, obviously they haven't retraced the huge move that they've made, but they have backed off some. And then you'll notice at the top, relative momentum reflects that both of them are extremely high, which in the past, when momentum has been, you know, this high, you see in the 30, the last time it was here, it backed off quite a bit. And so interest rates typically with momentum this high, even if the trend has changed, they deserve to back off for a little bit, because they went, they blasted off in a big way. What we talk about, everyone, that I think over a 5-month time period was the sharpest interest rate rally in all of history. So that puts some perspective, you know, to it. And that was in a 34-year time frame. So long-term summary of this, yields are still in a long-term downtrend. They hit resistance and backed off of late with momentum very lofty. Now here's the flip side. Here would be TLT on the first chart on the left. MUB in the middle is the National Muni Bond ETF, and AGG is labeled as the aggregate bond fund, which would have short and long exposure, some corporates, and hence the name aggregate. It's a culmination of, an accumulation of different types of bonds. And we did buy that of late here near support. Don't have a lot to brag about, but we did try to buy it at support with momentum deeply oversold. So as I shared in last week's sector report, if you're wanting to go play bonds long in a conservative way, AGG would be one of the first places that you'd pick up. Its yield's going to be lower than TLT, not by a lot, but its standard deviation will be quite a bit lower. So if we were really fortunate that rates, for whatever reason, or that bond prices, excuse me, are at a low and ready to rally, humbly, and if it was going to be a big one, you'll probably be disappointed in the total return of AGG. Not that it would go against you, it's just its total return would be drastically different than the return on TLT. Standard deviations are a lot greater, so only, you know, when you look in the mirror, you know your risk propensity much better than I. So if you want to be aggressive on the interest rate, TLT on playing long bonds would be a much better play than AGG. But as I set up alerts, as you can see towards the top, all of these are deeply oversold to levels seldom seen in the last 10 to 15 years. And also got an alert on a positive breakout to the upside of LQD, which is the corporate bond ETF. So we're seeing some, you know, obviously that they're all acting similar. They hit resistance in the bond prices last July where we shorted them, and now they're at support, and we're trying to pick them up at support, and also a time when hardly anybody likes them. So this is from sentimenttrader.com, and this is the position of Hedgers, and you'll notice we're going back about 8-9 years. This is where we shorted bonds last summer, and so typically in the past, when the hedgers have taken this type of a position on an aggregate basis, bonds were close to a high. We saw that again last summer, and that's when we shorted bonds. But you'll notice of lately, money is piling in, believing that bonds are going to continue to go lower in prices. And as you can see, this spike up, you don't see anything like it going back to 2009, and it's also at one of the highest levels. So there is a lot of people shorting bonds right in here. So if some surprises would happen in the bond market, this would represent a crowded trade and a lot of people on potentially the wrong side of the trade. So we just looked at hedgers positions. Here is sentiment on the 10-year note, and you'll notice this was this past summer when we shorted bonds. There was almost 100% of the people were bullish bonds when we went against them, and now when we're trying to nibble and buy some bonds at potential support, we see 0% bulls. So from my side of the fence, the power of the pattern, I like the patterns that we see. I like the relative momentum that we see, and also sentiment for a bond rally. And I'm not, by liking bonds at this type of a position, or from a power of the pattern perspective, it's not trying to put together a macro puzzle and say, because bonds will go up, stocks will do this, or it means this or that. No comments on Trumponomics, good or bad. I'm just not into that, folks. We're into prices and emotions. So one of the, this is the 30-year, excuse me, this is the 10-year German Bund over the last 35 years. And as I've been sharing this, month after month and week after week, this is probably one of the higher quality trends in bonds on the planet. Right now, the Bund is still at support in the upper right part of this chart. And I try to use this as a proxy. I think this is one of the most important bonds on the planet. If this 35-year channel would break, I do think that would send a concerning message to bonds. It wouldn't all by itself singularly tell that the 30-year rally in bonds is over, but to me it would be bad for bonds if this would break support. But right now, since particularly 2007, it's paid every time to buy it on support. We'll see if it's different this time. One of the things, as a lot of the talking heads on TV, we have a new president trying to do a lot of things that a lot of people on the surface seem to like, and there's been a lot of talk about whether the new administration can get the world to grow. So this is a kind of a growth / inflationary ratio. This is the TIP bond divided by TLT. And so we shorted bonds right down here when hardly anybody felt like, this is another way to look at the inflation-deflation battle, everyone. And so, not that it answers everything, but back this past summer, hardly anyone felt like inflation was something of a concern. And then you can see this ratio has shot up a lot. And then all of a sudden, copper gets some traction, the market, moves up, and people think, oh, inflation's back. Well, this hit potential triple resistance here. This is a weekly chart, everyone. Let's see, this is this week, so 1, 2, 3, 4, roughly 4 to 5 weeks ago, and you see that it's backed off. It hasn't collapsed by any stretch, but it would say that so far, the trend in this ratio is lower highs and lower lows over the last 7 years. Hit resistance, and so far has done nothing more than it did here, that it did up here on this channel. So, how the dollar plays out in some metals, whether all of us should own DBB, the base metals ETF, a lot of it will have to do with how this ratio does. If this continues to fall, I suspect that government bonds do well. If this would break out, some of our inflationary plays would do well. So I just kind of wanted to update you that this had a really sharp rise from July till let's just call it December the 1st, and then it's backed off since. So just kind of wanted to update you. No new inflationary pressures are coming from here, but also it's not sending some giant deflationary message either. So I want to turn now away from bonds and go to stock indices for a while. And I'm just going to start it off with the AD line, and I could probably stop right here as far as charting wise and say this probably tells you enough. It does, to me, it should tell you a lot. But this is the weekly AD line going back as far as it can go. That's based upon common stocks only. The New York NYSC AD line, the regular AD line includes closed-end funds and bond funds, and so stock charts and other places will give you the ability to strip all that stuff out, to me, which is noise, and just look at common stocks only. You can see it's obviously in an uptrend. We're close to all-time highs. So this is a positive message from underlying strength. Last week, 2 or 3 days in a row, we've seen some microscopic things that could become bigger. Tidal waves don't start huge in the ocean. They start way out there, and they build momentum. So it's interesting to me. It almost makes me think that, it's almost a bullish sign that you just see a couple of little negative things in the market, and it's unbelievable on social media and on TV. Holy cow, there was 3 more issues declining than advancing. That stuff could end up meaning something in time, and we want to not overlook it, but it's not like it's any big thing when you see something this strong going up. Here's a drill down on the daily NYSC only, including all issues. So you see a little bit of weakness up here at the upper right, nothing dramatic. It would get my attention. I didn't draw a line, but if you could imagine this is in a sharp rising channel, if it would break that support, that would get my attention. But right now, from an AD, lifting up the hood perspective, looking underneath the hood, how's things going? Right now, it's a positive sign for the long risk-on trade. So this is a 4-pack we've been sharing a few different times that I want to reiterate. They're all in uptrends. We have the S&P in the upper left. Financials and how they're doing is very important to me. We got banks in the upper right. This is the BKX index. We got small caps in the lower left and transports, in the lower right. They're all in quality uptrends. I'd say that the two better trends of the two are on the left side of the screen with the S&P and the Russell. The transports and banks aren't quite as good, but definitely transports are stronger on a longer-term picture, than banks. And I just say that from nothing very intelligent. It's just that here was the high 2007, and banks aren't below that, and everything else is above it. That's why I say the others are stronger, than the banks. But the thing that jumps out to me is, they're in uptrends, but they're all four facing important breakout tests at the exact same time. So on the flip side of that, the risk-on trade would not want to see weakness start taking place in the major indices right here, as also they probably wouldn't want to see bonds find support at the same time, and rally. The one that I guess intrigues me, the most is that if you look at banks, take the red lines, the bank index is up against highs that took place in 97 through 2000. If you look at this black channel line, this is where things collapse, so it's kissing the underside of that. We look at the blue channel line. So banks right now, which to me are extremely important, we own banks at the time of the election. It's amazing, folks, 60 days ago, had the election, going into the election, there was a lot of sad faces, scared faces, very few bulls, plenty of pessimism, and as I shared the day of the election, we own banks in the States and in Europe. We're long places, we're shorting some bonds, and if we would be probably wrong, I shared this, if we're wrong on one position, we're probably wrong on every one of them. Got greasy, but all that matters to me is it's just interesting how much things have changed from a sentiment perspective from 60 days ago to now. It's one of the things that fascinates me, and I think the opportunities, folks, I think last year people used the election as an illegitimate reason not to do much, but it's now gone. Some people find other reasons to think it's legitimate not to do things, but I think we're going to see more volatility come back than the kind of the stalemate that we saw last year. You can see that we picked up some of our trading activity, and from essentially September, on, we've been lucky and blessed, and thanks for the kind words from many of you, and people talking about extra Christmas presents or different things from some trades. But what I want to just say is congratulations to each of you that did that, because you were the one that had to make the actual trade itself. We just hope to empower you. So the trends are up on these, but they are facing really important levels, like I said earlier, where you wouldn't want to see the risk-on trade start seeing some weakness. We'll just go through each of these real quickly individually. Here's the S&P. You can see that if you take the 2006-07 highs, then 2014 it's up against that resistance line with momentum lofty, not as high as it has been, but it's still above the, or the concerning stage. You might want to say it's overdone. But a big test of channel resistance taking place in the S&P here. Here's the bank index that we just looked about. We're staring at triple potential channel resistance, kissing the underside with momentum seldom this high. There was one other time in 2013. It's even higher than 2002 or in the late 90s. So big test, right here. The risk-on trade in the States and around the world, I think, would benefit greatly, regardless of the momentum being where it is, if banks can break above this triple resistance. I would have a small remaining position in the banks, but if we could get a breakout here, I would enter a new position, because it would be something that I really want to respect, which would be a triple breakout. Here's small caps. We can see they've been in this really clean rising channel for what, the last 27 years. Very few times, I guess we could probably say 95% of the time, small caps have stayed within this channel. Momentum is being overbought. Small caps had a really strong rally. I think they're one of, if not the strongest sectors since the time of the election. This would be a place, if we would see some weakness, which is not taking place. I want to see the AD line start deteriorating more than it is, get a message from shoebox and junk. But if I was to look at one of the 4 charts, and if we would see weakness that I'd want to short, it'd probably be small caps, just because of the huge run-ups that they've had of late. And then here's the transportation index. This probably won't mean a darn thing, folks, but you'll notice prior to the 2000 high, there was a double top in the transports here, and it was a slightly higher double top. It would have been easy to get fooled, right in here. This is a positive sign, but boy, once steep support, which I don't have drawn in, was broken, transports underperformed for what, 5 years. We saw the same thing in 2007. So there's just potentially a quirk, but right here could be a double top forming almost at the same angle. So the risk on trade in stocks would not want to see transports start turning weak here, as relative momentum is fairly high. So summarizing, all 4 of these are in an uptrend, and all 4 are testing channels that they've had a tough time getting much distance above many times over the last 10 to 20 years. This is just a smart money, dumb money, just to kind of show you. The blue is what smart money is doing, and the dumb money is the opposite. So it would be an easy one to pick out. That the smart money right here had went very long, timed it well, just to kind of give you perspective. When the market was at a low, just kind of picking on this extreme, dumb money was out of the market. So you can see that it's not flawless. I know this is a fairly noisy, chart, but I just kind of wanted to show you that right here, when these two were essentially at the same level or kissing in price, this was 60 days ago. So in other words, smart money had started getting more long, and dumb money was trying to back away. And you can see for the most part, both groups, well, dumb money was on the wrong side, and smart money was on the right side there. So not too many times do we see the spread this wide between the two. So just to kind of summarize, the takeaway here is smart money is concerned about where the market is right now, and dumb money is quite bullish. So we're seeing quite a bit of euphoria in dumb money, which makes should make one be a little bit cautious when we see dumb money feelings or sentiment that high. I mentioned junk bonds earlier. This is J&K going back to 2007-8. J&K has diverged against the market over the last few years. It's had a nice rally last year, and it's backed off, and then it's had a little. This was a divergence that to me was concerning. Then we've seen a rally in junk. So right now, junk is testing triple resistance in a downtrend of lower highs and lower lows over almost a 10-year time period. For the 4-pack that we just looked at to do well, you want to see junk also participating in this. Would be concerned about it from a risk-on perspective if we would see junk turn weak here as the other key indexes or indices are up against channel resistance. So now I kind of want to move on to some thoughts on the metals market, gold, silver, and copper. I wanted to start out with that this is the gold US dollar ratio over the last 30 years. So if we would just look at this line and this line, you can see that the gold, when this is moving up, gold is outperforming the US dollar, and you can see from 2001 and 2 on until 2011, for a decade, gold was much stronger than the dollar, and so gold went from the bottom of this channel to the top, and then you can see since 2011, for the last 6 years, it's remained inside this red channel, representing a series of lower highs and lower lows. So now, to me, folks, a really big test is taking place that the 6-year channel is down, but there's a chance that it hit a key support level here, and it's testing that same line again, along with, at the same time, the bottom of this 11-year rising channel. So for the metals to do well, you want to see this ratio going up, which would reflect that gold is actually stronger than the US dollar. If this would break down, which would represent that the dollar is stronger than gold, it would send a very negative risk-on message to the whole complex. So right now, support is support, and it's still broken. And as all of you know, when this was just taking place recently, this is a weekly chart, about 2 weeks ago, between the Christmas and New Year's holiday, we went in and I wanted to take an aggressive position, but not take it size-wise. I wanted it in standard deviation. And so we went into the junior miners to try to get a good pop out of things, and we've been lucky and blessed so far. So from a 35-year, 30,000-foot view, folks, this is really important for anybody that wants to be long the metals. This is almost a must that this puppy holds, you know, here. So again, support is support, and I'm going to look to try to be a buyer on these support lines, because the stops can be set fairly tight below it if we have a breakdown. And if we would see a breakdown, then that would mean that the 6-year trend of lower metals prices is still intact, and shorting would be the play. But right now, from a TBNN perspective, we're trying to do some buying on potential support. First arrow was 2011 where it peaked, and there's the support, you know, right now that's key, the last arrow that came in. The one troubling thing that I would sure love to see a lot better is this is the Swiss franc. You know, there's a high correlation we've continued to talk about. You know, in 2011, we pointed out right here that metal should be flat to down for years to come, and it's been accurate. And for that to end, we want to see strength from the franc. So the positive here is this is a 10-year support line that the franc so far has continued to stay above, which is almost a must, you know, for metals. There's a couple of other support lines coming in, but the thing, this is not about being bullish or bearish, or trying to pop any balloons. And remember, Chris doesn't make these charts. Billions of free-thinking people do. So the thing that jumps out to me is this pattern has the appearance of a descending triangle, which is characterized by a series of higher lows and flat bottoms. Roughly 65% or 2/3 of the time, this pattern results in lower prices on a break of support. So the risk on trade in metals does not want to see this pattern be true, nor does it want to see support broken. If it does break here, the measured move would suggest that the franc would fall, you know, roughly from the dollar level down to at least 85 into this range. And you can bet, if it would happen, if the franc would fall 15%, you can bet metals would fall at least 15, because typically it's more than a 1-to-1 ratio. So this is really critical. I would just, I'm not a gold bull or a bear. I'm just an opportunist looking for solutions, looking for movement opportunities. If the franc would break out of here, I think you'd be really pleased on the type of opportunities that metals would provide you. So again, if the metals, for the metals bear market to end, you sure want to see some franc strength around the 98 to $1 level. This is the GDXJ junior miner / GDX senior miner ratio. As you can see, it remains in a downtrend characterized over the last 7 years by channel 1, which is a series of lower highs and lower lows. Excuse me, got a bad habit this 2017, I'm getting ahead of myself. We bought GDX right here where the ratio to me appeared to have support, and we've seen this sharp rally of late. It has not proven anything other than it's a rally in a downtrend, but the one thing that if you're not long GDX or GDXJ, if you'd see a breakout, I would encourage you to be on board, especially if it could get above the 170 level. Now, if you're not on board, but if this ratio breaks out, it would still be a positive message to GDX as well. It would just suggest that, as has been accurate, If you've owned GDXJ and GDX over the last several years, you've lost more in GDXJ than GDX. What we're trying to do is see if we can get the flip side going and some strength in these miners. So nice rally of late. We bought GDXJ here, which showed we got lucky and blessed on that move, because GDXJ has been much stronger than GDX, up almost 50% more, I believe, in the last few weeks. But still, humbly, nothing has been proven here. It's just pushing a real sharp rally up and nearing falling resistance. I hope for the miners. There's not hope in the strategy. And yes, I'm biased. I'm long this. But for this bear market to end, you have to break out these channels, and so far it hadn't been done. But again, if it does break out, if you're not an owner now, I think you'll be rewarded by being long if we can get a breakout here. This is looking at copper. We bought Doc Copper down in here, then we faded and sold our shares, harvested. And just the reason I did it, we harvested into before this peak, is just that no different than the ratio that we just looked at, is Doc Copper's in a bear market, continues to make a series of lower highs and lower lows over the last 6 years, and we're now making a curl similar to GDXJ, coming back up here to nearing, it's not there yet, nearing dual resistance. Obviously, Doc Copper, as much as I like the name and what it could mean, even though it fell for several years, it was true about commodities, but Doc Copper's negative movement didn't impact stocks. But from a global perspective, if we want to see growth around the world, for that type of risk on trade, you want to see copper breaking out. And so it's had a good rally today, and it's nearing dual resistance. So if this would break out, obviously owning JJC would be a play. And as we shared in last week's metals, it had a really good day today. And it's had a good week as Freeport-McMoRan, FCX. So this would be a positive play for both JJC and Freeport if we could see a breakout above dual resistance. This is an alert on a break above 3106. I'll be a buyer. This is GDX only. GDXJ had fallen, lost about 50% of its value when we bought it just a couple of weeks ago. We've been fortunate that it's up 20–25% since purchase, but it's, that's behind us now, or we're going to try to do our best to at least keep those. Was a positive break above falling resistance. If you are not an owner of GDXJ, the green bar at 38.14 is a buy that I have harvested some of the GDX holdings. If we can get a breakout above that 38.14 level, most likely I will be a buyer of some more GDXJ. So just kind of wanted to let you know. Seeing some positive price action. Last week we did see a little bit of a reversal, and we've seen a pop. So you'll notice there's a reversal wick there last week and this week, right below overhead resistance. That's why I want to see this thing prove itself as far as continued strength before I'd be a buyer of anything more. But if it does, I would be interested in buying some more of it. Now, kind of turning to the oil patch. This is really another 30,000-foot view going back, 34 years. But the majority of the time, crude oil has spent, 90% of the last few decades inside this blue shaded area. And obviously it broke out of it earlier this past year and rallied up. And so of late it's kissed the underside of dual resistance. And so for the risk on trade to do well in crude oil, it needs crude oil to get back into this blue shaded area. And it's kind of hard to tell right here, and we'll see it on the next screen. But so far this week, I know we're just 2 days into it, and 2 days doesn't prove a darn thing. But you'll see it in this next slide. We're going to focus in on this area. This was last week, folks, which has a chance to be a doji star. that looks like a plus sign. You see the opening and closing are almost the same with some movement in both directions. Oftentimes these plus signs or doji stars can take place at market highs. And so for the risk on trade for crude oil, that's not what you wanted to see last week. And the next thing that you would not want to see in the risk on trade in crude oil is weakness following the doji star. And this doji took place. Remember, folks, I'm going to go back to the prior slide. The red and the blue line that we're going to see highlighted, this is what we're looking at, just this little section, right here. That doji star took place on those two very long-term resistance line. It's kissing the underside. And like I said, 2 days does not make a trend this week. But so far this week, we've seen weakness in crude oil, which, we've seen a high correlation. We'll look at that in the following slide between stocks and crude oil. That has not always happened through history. This tight correlation someday will break, but right now they remain, for whatever reason, highly correlated. And so I think this would be concerning for the risk on trade in crude, energy stocks, and the broad market if we would see, continued weakness here. And obviously the flip side, we've talked about it since this past summer. We sent an email out right here that we thought the crude oil needed to decline to form the potential right shoulder. This could be the right shoulder, head, left shoulder. Even if that read is not correct, this has the look of a bullish ascending triangle with a measured move up to $75 if crude can break out. So again, the longer term trend in crude is still down. The 1-year trend in crude is up. They're both battling each other right here at these dual lines. And so I continue to humbly believe that what crude does in the attempt to get back into here, I think success, a breakout here is success to the upside, would be a positive, obviously, for many, many things. And this would be not a place that the risk on trade would want to see weakness. Now, if weakness started taking place right here or right here, there's no chance bonds would like that. So we'll just really important price levels, and we can see now for 1, 2, 3, a whole month, crude oil has not went anywhere up against these long-term lines. So to me, very, very key price, just below the 55 level. Here's the overlay that I've shared many times over the past few months. But again, this is crude oil in the red. This is the New York Stock Exchange in the dark. And you can see they always don't correlate, and particularly from 2013 to probably 2015 for 2 years, they didn't correlate well at all. But from late 2015 for the last 18 months, these charts look a lot alike. And so if you see weakness here, you could also see some weakness in stocks here. So they remain correlated, and I believe crude oil will have a big impact on the broad market, what it does with this pattern and up against dual resistance. We did get, we traded the energy ETF and took some profits, brought up some stops. The negative price action in XLE, I think it was yesterday, hit our stop trigger. So at this point in time, completely open to very positive things in the oil patch, but we don't have any long exposure in XLE, but do have long exposure in Weatherford, WFT, which is a very, very aggressive play, just own a half position, small size in Weatherford. You've seen the chart. Sorry I didn't put it into here, but Weatherford's down, it's down 90–95% from highs several years ago. Potential cluster of support. But I will say this, that if crude oil fails here and starts turning soft, we'll get hammered pretty hammered hard, I would suspect, in WFT, and our stock will be hit. Now turning to the currency markets around the world, this is the US dollar looking back over 30 years, and you'll notice that 2 different long-term channels are meeting right here, and this is a monthly chart again, everyone. So this is a dual channel resistance kiss, possibly for the dollar. This is a monthly chart, so obviously we're not very far into 2017. This is last month's activity, and we've seen so far a little bit of a reversal, but nothing proven on a monthly chart. But if the dollar is to reverse, this would be a price point. The dollar is in an uptrend over the last decade, series of higher lows and higher highs. So this is a huge breakout attempt, and I can't think of anything more. I try to explain that to me, when you think of, say, a dog, the body and the tail, the currencies are the body, and the tail is the plays that we can create off of how the body wags it back and forth. And so just kind of like when I see some weakness in the dollar, I don't want to, I'm not very inclined to short the dollar as much as I am to go long silver or long copper or long the miners. Because if we can get the dog right, being the body and how it's going to wag things around, I'm much more interested in the higher standard deviations in ripple plays off of dollar strength or weakness. But again, right now, dual 10 to 20-year channel resistance in an uptrend is being faced by the U.S. dollar here. This dollar strength we'll see has pummeled and punished commodities over the last several years. We'll look at the worst and best performers in an upcoming slide. But if the dollar would turn weak here, the things that have gotten pounded over the last several years could really provide some opportunities. But again, this would be a counter trend play long in commodities because the trend is still down. Here's the euro. This is a good example of a trend being down and one that's highly correlated with commodities. But here's the euro over what the last 20 years. You can see the euro has remained inside this downtrend, but it has found some support, potential support, right down here, almost triple support, which that's where we went and went long GDXJ as the euro was down here testing these levels. So commodities, metals, worldwide growth most likely would like to see some strength in the euro. If we would see euro weakness, dollar strength, the commodity play will probably be to the downside, in bearish or shorting versus to the long side. We're going to look at some. We're going to look at what assets have done well and poor over the last 4 years, and I'm going to try to dig into the poor side. And this is really a busy chart. If any of you want it individually, outside of the PowerPoint, you're welcome to it. This is what we would just want to call a broad market scoreboard with a lot of numbers. You can see, you can look at 5-day performance, month to date, 3-month, year to date, past 52, 3, 4, and 5 years. But this report, everyone, is sorted based upon 4 years. So you can see the color codes. The best 4-year performer is the Qs, up 92% over the last 4 years, with the worst being wheat. So one of the things we're going to see in some following charts is if we want to buy low and try to sell higher, we're going to look at some charts on wheat and oil and corn, diesel. It's a couple other charts, and we'll send even more in time. But at the beginning of the year, it's always constructive for me to look back and even ask ourselves the question, 4 years from now. So it's hard to believe, like the show 2020, 4 years from now, we could be at the year 2020 or 2021, either one. Can you add 4 years to your kids, to your own self, to your grandkids' lives? But, thinking about, 4 years from now, will these remain top over the next 4 years and in the green, these very hot performers? And will these things that have done poorly over the last 4 years, will they still be here 4 years from now? Obviously, that's an answer above my pay grade. But if I was betting a dollar, I'd say I don't think I'll see this. I don't think any of us will see this exact repeat 4 years from now. So I just want you to kind of keep these perspectives in mind as where are buying opportunities here and where are potentially harvesting opportunities here. Just because the top indices are all stock indices or the top performers over the 4 years does not mean that a bear market's going to start or anything bad, but it does mean that this is a rare performance. And then you can see over the last 5 years how some of those, not sorted by 5, but I love this color coding because just like even if you just do 52 weeks, you say, well, what's the best? You can start looking for what's like the greenest to be the gold miners, and then what's the worst over that time period. Looks like cocoa. So I hope this chart can be of value to you. From a perspective for myself that I want to share with you is I want to start looking in and trying to find potential opportunities if the dollar would turn weak and if it would peak out here, is what type of opportunities can come out of all these numbers that are really got a lot of red down in here in the same assets clustered over a 3, 4, and 5 year time period. Here's wheat, which we just said was one of the worst ones. It doesn't matter if it's wheat, corn, or beans, or JJG, which is the grain ETF. Grains have been soft. These ETFs have been doing what they're supposed to because the underlying assets have been weak. But I've got a couple of alerts set that if we'd see wheat rally just another 150 basis points, 1 to 1.5%, we'd be triggered and send a buy signal. So kind of wanted to update you, where what wheat looks like. This is livestock ETF cow. We bought cow down here after it suffered a large decline, and then as it rallied and neared resistance, we harvested and sold out of the position. But if cow would break above dual resistance, my alerts would suggest to go back to cow. But right now we bought it when it was under what we thought was undervalued, and we sold into strength. Again, cow is still, as with almost all commodities, it remains in a downtrend. And I don't want you to be deceived by cow. Cow is a livestock ETF, which includes hogs inside of it. So this is a cattle hog protein ETF. But again, it's in a downtrend, and just like so many of these things, each rally has been a rally to harvest and to short strength. Someday that's going to change, but I do have the different alerts set that if cow would break out and show further strength, I'll go back to it. This is a BHP bulletin, which has done, this is a 30-year chart. I wanted to show you this long-term perspective because of how important of a price point BHP is. This is the commodity decline since 2011. It's in a downtrend, but it's kissing potential, it's nearing triple overhead resistance. But if we would see dollar weakness, I think you'd see BHP strength. And so I have alerts set that if BHP would break out, I'll be a buyer, and I'll let you know of that. Here's corn. Looking at another grain that's, as with all of the grains, they're going to continue to set the series of lower highs and lower lows. We see a little bit of a curl down here, potential a pin pattern forming. And if corn would break to the upside, I would want to be a buyer. Have no position in it right now. It's continued to be choppy for several months. But again, open-minded to strength. I have alerts set that if a breakout takes place, we'll let you know. Another one that's been hammered over the years is natty gas, the UNG ETF. There's a chance it's forming a bullish ascending triangle. It hit triple resistance here and has backed off hard of late. It's going to have an opportunity, or it's getting near a test of rising support. But if this is an ascending triangle, it would suggest a 2/3 odds that natty breaks to the upside. You can see it's been really a very narrow range outside of some real choppiness and some big moves that takes place. If you're fortunate on the right side in an up move, this really treats you well, and it hammers you on the flip side. So I have an alert set at 9:54 that if natty UNG breaks out, I want to be a buyer. As we're getting near the wrap-up of this month's session, this is our seasonality chart on strong stocks historically in the month of January over the last 10 years. Our criteria is that the stock had to be in business for 10 years and that 70% of the time, or 70% of those Januaries, the stock was higher. And then here's your average returns and your medians. And so picked up today SYK and BSX. Boston Scientific, but I'll get you this whole piece. But you can see that, you know, on average, January didn't have a lot to brag about, you know, so these numbers are all okay, but there's different months that look a little more spectacular, you know, than this. So I'm really trying to look at some of the patterns, you know, that are there, looking for some breakouts. We're trying a couple of them today, but we'll get you this chart, and then we'll try to even dig into more of the individual chart patterns, you know, for you of the seasonal strongs. Here was one of the seasonal strongs, Boston Scientific. You know, it's in a long-term uptrend over, you know, as with, I would assume somebody could label this a healthcare stock. I'd also assume it could possibly fall under the umbrella of biotech. But we know if it does fall under biotech, biotech's, you know, been pretty weak. But regardless, the trend over the last several months for BSX is down, lower highs and lower lows, but it is testing dual resistance that I bought BSX up here in case it provides seasonal strength through the rest of the month of January. Obviously, if it would break out above here, it could do really well, you know, but humbly there is dual resistance that it's facing. So if you weren't a buyer or you want to set back, totally understand. I took a half-size position. If it would break out to the upside, I'd even buy more. You can see its median gain in the table in the upper left for the month of January is about 9.5%. 70% of the time it's higher in January. So I've got a couple of alerts set that if it breaks out to the upside, I'll also let you know on that because I'll probably be, my plan at this time would be to buy some more if it did. So in wrapping up, you know, we had the election 60 days ago. I think it's kind of throwing an excuse for people not to do some things. So we're seeing movement, standard deviation, you know, pick up, and that's exciting. I have no idea how the inauguration turns out, but you know, folks, I'm just my main emphasis is the power of the pattern. As you know, I don't lay out any grandiose plans of, you know, I don't know about you guys, but do you know what you're having for supper Sunday night? I think it's always amazing how they're asking, well, where's the stock market going to be a year from now? Or do you know where you're going to eat and what you're going to have a year from right now? That's pretty tough to know, you know, even this weekend. So I never try to say that I've been empowered by any source to know where things will be long range out there. But I do feel completely confident as I lay my head on the pillow at night that the power of the pattern has treated us well. It will treat us well, and that movement is our friend, and that regardless of how this grand experiment turns out, folks, I'm really excited about 2017 and beyond. I do believe that, you know, we got into that boringness almost for 12 to 15 months going into the election where the S&P just chopped sideways. I think it's lost some of the excuse for that to happen, and I think movement is here and movement's back, and we're going to take advantage of it. So again, as we started out, you know, this webinar, I want to wish all of you a healthy year. I hope you have a happy year with your family, that things go as you deserve. I wish for you great opportunities, and Rick and I really appreciate, you know, your membership and your trust with us. We will do our very best that we can at this end to make your membership a great value. So thank you very much, folks, and we'll see you roughly about 3 weeks from now.